Hello, this is Gauri Gaur. Today's topic of discussion is Theories of Capital Structure Part 2. We discussed net income approach and net operating income approach of capital structure in the earlier session. In this session, we are going to discuss the traditional approach and Modi-Gilani-Miller approach of capital structure. The traditional approach was propounded by Ezra Solomon in 1963. The traditional approach rejects both extreme prepositions of relevance approach of NI theory and irrelevance approach of NOI theory. This approach is the compromise between NI approach and NOI approach. It neither assumes constant cost of equity, that is KE, and declining weighted average cost of capital, that is WACC, like NI approach, nor increasing cost of equity and constant cost of debt KD and overall cost of capital KO, like NOI approach. According to this approach, weighted average cost of capital decreases only up to a certain level of financial leverage and starts increasing beyond certain level of judicious mix of debt and equity. Hence, a firm has an optimum capital structure when the weighted average cost of capital is minimum and the market value of the firm is maximum. As per this approach, the weighted average cost of capital declines with moderate level of leverage because expensive equity is replaced by low cost of debt. However, this phenomenon does not last long since financial leverage increases risk to shareholders and cost of equity. The traditional theory assumes that up to a certain level of debt, it remains cheaper than equity, and beyond that level, it becomes costly. The increase in debt results in the decrease in weighted average cost of capital only up to a certain stage where benefit of cost of debt is more than the increase in cost of equity due to increase in financial risk. It means the financial leverage is beneficial when cost of debt plus increased cost of equity is less than the cost of equity that was before debt financing. The moment when cost of debt plus the increased cost of equity becomes higher than the cost of equity that existed before debt financing, the additional use of debt increases the weighted average cost of capital and the decision of increasing debt becomes unfavorable and the value of the firm declines. Three stages of capital structure under traditional approach. According to traditional theory, the value of firm may first increase with moderate leverage, reach the maximum value and then starts declining with higher financial leverage. This is because the weighted average cost of capital first decreases and after reaching a minimum, it starts increasing with increase in financial leverage. Thus, under traditional theory, there are three stages of relationship between capital structure and the firm value. First stage is increasing value. In the first stage, the cost of equity KE either remains constant or rises slightly with increase in debt. At this stage, the increase in cost of equity is less than the advantage in cost due to lower cost of debt than equity. During this stage, the cost of debt KD remains constant since it is considered as the rational decision. Consequently, the overall cost of capital KO decreases with increase in leverage and thus the total value of the firm capital V also increases. Second stage is optimum value. At this stage, the cost of equity increases faster than it increases at the first stage when debt is increased. Further, the benefit of low cost of debt is wiped off by increase in cost of equity beyond certain level. Hence, the firm reaches a stage of minimum weighted average cost of capital and maximum value of the firm at certain level of debt equity mix where the optimum capital structure is attained. Third stage and the last stage is declining value. As the debt is increased beyond a certain level, the increase in cost of equity becomes greater than the advantage of low cost of debt and therefore, weighted average cost of capital increases and the market value of the firm decreases. At this stage, the value of the firm goes on declining with every increase in debt replacing the equity. This happens because investors perceive a higher degree of financial risk and demand at a higher rate of return on equity, which exceeds the advantage of low cost debt. Effect of financial leverage on cost of equity, cost of debt and overall cost of capital under traditional approach can be explained with the help of this diagram. The cost of capital curve is convex to the x-axis, which shows that in the beginning when there is no debt or a little debt, the cost of capital is higher. As more debt is introduced, it goes on declining and there is a specific point at which the cost of capital is minimum. And after this point, the cost of capital starts increasing with the introduction of more and more debt in the capital structure. As per this theory, the optimal capital structure would fall somewhere in the second stage. Now, let us discuss optimum capital structure under traditional approach. The supporters of traditional theory believe that overall cost of capital declines when the debt is used in capital structure, and it is possible to attain optimum capital structure. The capital structure is optimum at the stage of debt equity mix, where the overall cost of capital is minimum and the value of the firm is maximum. Now, let us discuss criticism of traditional approach. The traditional theory is criticized on certain grounds like: first is, the theory assumes that investors value the levered firms more than in the unlevered firm is not practically correct. Second is, risk for shareholders does not increase with the additional debt for financially sound firms. Third is, investors' perception about risk of leverage does not change for the same firm at different levels of leverage. Fourth is, optimum capital structure is affected by tax deductibility of interest and other capital market factors which are ignored. The last theory we are going to discuss is Modigliani-Miller, or we can say MM approach. In an article, The Cost of Capital, Corporate Finance and Theory of Investment, published in American Economic Review in June 1958, the Modigliani and Miller propounded their view on optimum capital structure, which is popularly known as MM approach. According to them, cost of capital is independent of capital structure and financial leverage does not affect the overall cost of capital. Hence, there is no optimum capital structure. MM theory is just similar to NOI approach with the basic difference. The basic difference is that the NOI approach is purely a definitional term, explaining the concept without behavioral justification, whereas MM approach provides behavioral justification in favor of the theory. MM approach is based on certain assumptions like: first is, capital markets are perfect where individuals and companies can borrow unlimited funds at the same rate of interest. Second is, stock markets are perfectly competitive. Third, there is no corporate tax. Fourth is, there is no transaction cost. Fifth, investors are free to buy and sell securities. Sixth is, investors behave rationally. Seventh, dividend payout ratio is 100% and there are no retained earnings. While prepositions of MM approach are, there are two basic prepositions of MM approach. Preposition 1 is, the market value of any firm is independent of the proportion of debt equity mix. Second preposition, shareholders expect more and more return as debt equity ratio increases. Now, let us discuss these prepositions in detail. Preposition 1, value of the levered and unlevered firm. As per this preposition, the value of the firm depends on the net operating income and business risk and not on the basis of financing pattern of assets. Hence, market value of the firm is independent of financial leverage. Therefore, the total market value of all firms, levered or unlevered firms having the same business risk, remains the same. Under this approach, value of levered firm, that is VL, is equals to value of unlevered firm, VU. Now, let us discuss cost of capital of the levered firm and unlevered firm. As the levered firm's value is the sum of the value of equity and value of the debt, under this preposition, the levered firm's expected rate of return is the ratio of the expected operating income to the value of the all securities. This is an average rate of return expected by all security holders, which should be earned by the firm on its total investments. In a levered firm, the average rate of return required by all securities holders is the weighted average cost of capital. Therefore, WACC is equals to KO or KL. The value of the levered firm VL is equals to NOI divided by KL, that is net operating income divided by cost of capital of a levered firm, while overall cost of capital KO or KL is equals to NOI divided by VL, that is net operating income divided by value of the levered firm, where NOI refers to net operating income, KA refers to opportunity cost, VL refers to value of levered firm, KL refers to levered firm's cost of capital, KO refers to overall cost of capital, In case of the unlevered firm, the entire income for the shareholders is the net operating income, its weighted average cost of capital or overall cost of capital of unlevered, that is KU, is equals to its opportunity cost of capital, which is KA. So, KA is equals to KU, which is equals to NOI divided by VU, that is unlevered firm's cost of capital divided by value of unlevered firm, where KU refers to unlevered firm's cost of capital, VU refers to value of unlevered firm. Since the values of the levered and unlevered firms and their net operating income do not change with the change in the financial leverage, the weighted average cost of capital for two firms, levered and unlevered, is in the same business risk will be the same and equals to the opportunity cost of capital. Thus, levered firm's cost of capital KL is equals to unlevered firm's cost of capital KU. This is explained with the help of a diagram. This diagram shows the irrelevance of cost of capital with change in the debt equity mix. The financial leverage does not affect the values of levered and unlevered firm and the expected net operating income. Therefore, the weighted average cost of capital KO also would not change with the change in financial leverage. Hence, the weighted average cost of capital for levered and unlevered firm will be equals to the opportunity cost of capital, which is KA. This phenomena is justified by Modi-Gilani and Miller by the process of arbitrage. Now, let us understand what is arbitrage process. MM's proposition works under arbitrage process. The proposition 1 says that value of levered and unlevered firms are equal. If this is not true and the market price of shares of levered firm is higher than the market price of the shares of unlevered firm as per the NI approach, the arbitrage process will take place to restore the equilibrium in the market. Investors will sell the shares of levered firm to get the higher share price and reduce the higher risk, and they will buy the shares of unlevered firm having less risk and lower market price. Consequently, the market price of the levered firm will reduce and the market price of the unlevered firm will increase. For this purpose, the investors will indulge into personal or homemade leverage against the corporate leverage, and market value of the share price of both levered and unlevered firm will be equal. Moving on to the proposition 2, perception of shareholders on financial risk. As per this proposition, the financial leverage affects shareholders' return in terms of earnings per share, that is EPS, and return on equity, ROE. The higher the financial risk, the higher the shareholders' required rate of return or the cost of equity. In case of unlevered firm, its opportunity cost of capital KA is equals to its cost of equity KE, that is KE is equals to KA as per proposition 2 of MM approach. Opportunity cost of capital remains constant with financial leverage, and this happens because the advantage of cheaper cost of debt is offset by the increase in the cost of equity. So, the opportunity cost of capital KA does not change. A levered firm has financial risk while an unlevered firm does not have the financial risk. Hence, a levered firm will have higher required return on equity as a compensation for financial risk. The cost of equity for a levered firm should be higher than the opportunity cost of capital is, that is KE is greater than KA. Cost of equity should be equals to opportunity cost of capital plus financial risk premium, that is KE is equals to KA plus financial risk premium. The financial risk premium is decided as, for a levered firm, cost of capital is equals to weighted average cost of equity plus cost of debt, where KA is equals to KE multiplied by E divided by E plus D plus KD multiplied by D divided by E plus D, or KE is equals to KA plus KA minus KD whole multiplied by D divided by E. Here KA refers to opportunity cost of capital and KD refers to cost of debt, while E refers to equity and D refers to debt. In case of unlevered firm, D is 0. Therefore, opportunity cost of capital KA equals the cost of equity, that is KA is equals to KE. From this equation, it is clear that financial risk premium of a levered firm is equals to debt equity ratio, that is D divided by E, which is the additional cost over cost of opportunity expected by equity shareholders. The core part of proposition 2 is that the levered firm's opportunity cost of capital will not rise even if use of financial leverage is increased. The excessive use of debt increases the business risk. Consequently, cost of debt increases with excessive use of financial leverage. approach emphasizes that when cost of debt increases, the cost of equity will increase at a decreasing rate and may even reduce. This is because that debt holders bear some of the firm's business risk and the operating risk of shareholders is transferred to debt holders. Effect of financial leverage on cost of capital under arbitrage process can also be explained with the help of this diagram. The diagram explains that as the debt increases beyond certain level, cost of debt increases. The increased debt would absorb the business risk, which gives relief to equity shareholders in terms of operating risk, and the cost of equity declines. As the increased operating risk of equity shareholders is absorbed by the debt holders, the overall cost of capital remains constant. Now, let us discuss criticism of the hypothesis. Hypothesis is criticized on certain grounds. First, imperfections do exist in capital market. The assumption of perfect capital market is practically not correct. Imperfections are bound to exist in capital market due to many varied factors. Because of imperfections in capital market, arbitrage may fail to work and market value of levered and unlevered firm may vary. Second is the assumptions of rate of interest fails in practice. The hypothesis assumes that firms and individuals can lend and borrow funds at the same rate of interest. The firm have always higher creditworthiness, hence they can borrow at cheaper rate of interest than individuals. Third is personal leverage is not a substitute for corporate leverage. The hypothesis assumes that personal or homemade leverage is a perfect substitute for the corporate leverage, which is not correct. This is because in case of shareholders, the liability is limited to the extent of their investments only, whereas an individual's liability is unlimited. Thus, it is more risky to create personal leverage and invest in the unlevered firm than investing directly in the levered firm. Fourth is the assumption of the absence of transaction cost is also not correct. The transaction cost of buying and selling securities does exist. Due to transaction cost, it is necessary to invest more amounts to earn the same return. And the last criticism is corporate tax does exist. The assumption of non-existence of corporate tax is also not correct. Practically, interest charges are tax deductible. This makes the cost of borrowing cheaper than the annual rate of interest. Tax advantage results in large return in case of levered firm if return on investment is more than the rate of interest. Now, let us summarize at the end. In this session, we studied traditional approach and Modigliani-Miller approach of capital structure, their views on relationship between financial leverage, cost of capital and value of the firm. Thank you.